Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be covering stocks with X dividends next week. So every week on Wednesday, we go over stocks that have X dividends coming up next week. We pick 5 stocks that have strong financials here. We'll go over the screening process, but I have 5 stocks for you guys. Ticker symbol PSA, which is public storage. Ticker symbol ADP, automatic data processing. Ticker symbol PB, Prosperity Bank Shares. Ticker symbol PKG, which is Packaging Corp of America. And then THG, which is the Hanover Insurance Group. So a variety of stocks coming up this week. Now, what I screen these stocks for this week is initially yields greater than 1.5. If you're investing $100, you'll make back $1.50 or more depending on your investment. I want all these stocks to have rising revenue, net income, free cash flow, moving positively over the last 5 years and the last 10 years. Their price to earnings currently in the future, it's expected their forward price to earnings is expected to decrease, meaning that they're becoming more profitable, so less than the current PE. And then next year's earnings per share are growing. They're going to be growing their revenue, their earnings, and then in comparison to the current year earnings per share. And then of course I like to see that they've grown their dividends for the last 5+ years. One of the stocks, actually 2 of the stocks in the list today have grown their dividends for 10+ years. And then of course in the data we discussed the dividend dates, price comparison to yield, PE comparison to the industry, the payout ratio, dividend history, and a few other statistics. So that's what we're going to be covering today. These stocks are all ordered by the ex-dividend dates between September 10th and September 14th, which is coming up next week. And of course, if you are brand new to the channel, I do make stock market, finance, and real estate related videos weekly. So if you enjoy any of that, go ahead and hit the subscribe button, and I will have this article in the description below and also in the comment section. So stock number 1, ticker symbol PSA. It's a public storage and real estate investment trust. This is a REIT that deals with public storage. I know a lot of people that get into real estate, they're looking at public storage right now. It's able to survive the downturns and the recessions. So this REIT owns and operates self-storage facilities in the United States and Europe. The company operates in 3 segments: domestic self-storage segment, Europe self-storage, and commercial. Their ex-dividend is the 11th of September, which is next Tuesday. You would then get paid out on the 29th of September. So here, their 10-year chart, basically what I like to kind of showcase is if you take their dividend growth, their price, their revenue, divide it by 10, and that gives you your change per year, on average. So here, dividend, for example, it's up 263% over the last 10 years. So if you were to divide 263 by 10, you're looking at them increasing their dividend payout by 26%. Looks like they had a special payout over here, so this could be slightly off. But you can see here, for the most part, they had some very steady increases here in the past, and then just recently have been raising their dividends between 15 and 16 by a very large amount. And then here, a little bit periodic between 17 and 18. Looks like there hasn't been a hike so far, so they should be due to increase their dividend here very shortly. Here, their price up 139% over the last 10 years. That puts them at around a 13.9% average per year. Revenue, free cash flow, net income, all growing at a steady double-digit growth. So everything's over 5% there on average per year. So very steady, just nice in growth there as a REIT. Now, this is their 1-year chart information here. They pay out $2 per share each quarter, putting them at $8 per share for the entire year. They're currently priced at $213 and have a current dividend yield of 3.75. Here I have their information here as well. They have a current PE ratio of 29.68 and a forward PE at 28.97. Their price to sales is at a 13.68 and their price to book is at a 7.6. So when charted, it does show the current stock does have a higher yield to price. So here, the yield for the average here, you can see that the yield for a time back in early January, February timeframe when we had that 10-15% pullback, the yield had actually exceeded 4.25%. It was actually up here maybe in the 4.3s, but it has pulled back. Price has came out of those lows, and we can see here that we're right about valued, with the yield slightly trading above the current price. So I would say that this stock is either undervalued or at a value buy right now. Just looking at that number alone, that doesn't paint the whole picture. Now, stock is above the industry average of 26.3, and it's also sitting above the S&P 500 average of 25.10 currently. So this stock is currently trading at a 29.68, and it's not expected to drop below the industry or the S&P 500, putting it at fairly expensive here. I don't have any comparables to it, so it's really hard to do comparables, but just comparing it to the industry average and the S&P 500, it is slightly overvalued for that position. So it is sitting above 60% payout ratio. It's a REIT. They're designed to pay out a little bit more. Normally, 90% of their earnings are paid out to their shareholders to avoid taxes and such. So this one does have a payout ratio right now of 76%, and they've grown their dividend for the past 8 years. Their price to book value, as we've seen, is 7.6, which is above 3.0, where value investors would consider it a value, but it's all due to the comparables. You have to just look at comparables, but right now, just kind of looking at the price, the yield, the PE is slightly, very high. If you had bought this stock during that downturn in February, you would be up a very nice amount. You would have locked in a very healthy yield, and you'd be sitting, pretty nice looking stock right now. But right now, looks about valued at this current time. Second stock here, we have ticker symbol ADP. Automatic Data Processing is an outsourcing company that provides technology-based outsourcing solutions to employees, vehicle retailers, and manufacturers. It operates in 3 segments: employee services, professional employee and organization services, and dealer services. So a lot of companies, they use ADP for their human resources, to log in to payroll. I've done that at both of my past jobs and my current job. We use ADP for our processing. So here, their ex-dividend date is on the 13th of September. That is next Thursday. You have to buy this one on Wednesday or prior. You'll then get that dividend payout on the 1st of October. So again, 10-year chart here, you can see that their price has came up extremely high here, 227% over the last 10 years, and a lot of the growth is here just within the last few years. So on average, if you had invested in the stock for the past 10 years, you would be up nearly 22.7% on average every single year, or 227% on your initial investment right back after that crash of 2008. Their dividend, they've increased it on average by 13.7, and again, their revenue, free cash flow, and net income is also positive over the last 10 years, moving up here in the double digits. Not as fast as growth, but this is a larger company. I believe they do have a larger market cap than the storage company. So here, looking at their 1-year chart here, ADP pays out 69 cents per share each quarter. They're currently priced at $46. They have shot up extremely high after that pullback in February. You can see here they were trading at $110. They had actually, hit 110, broke out, hit 110 again, and then went from straight $110 to $146 now in their yield. I owned this stock back in 2013 or 2017. And I had this locked in at a 2 or 3% yield. It's a very healthy yield. Now you're currently yielding a 1.73. So I would say this stock is highly overvalued at this current time. PE ratio is sitting at a 39.83, expected to drop with earnings to a 28.2. Its price to book is at an 18.49, and its price to sales is at a 4.8. So right now, I would say this is a very expensive stock. So when charted does show the current stock does have a higher price over yield, which would indicate it may be overvalued at this time. The stock is above the industry average of 27.2. It's also above the S&P 500 average of 25.10. Again, sitting nearly at that 39.9 or 40.1, depending on where you're getting these numbers. I pulled them off, Y charts and Morningstar. So dividend yield around that 1.89, 1.73. Annualized payout, they pay out $2.76 per share, or 69 cents each share each quarter. They have a 53.3 payout ratio, which is very healthy, and have been growing and increasing and paying out those dividends for 43 years. So for the past 43 years, they've not only paid out a dividend, but they've also increased it year over year over year. Stock number 3, we have PB. This is Prosperity Bankshares, provides financial products and services to small and medium-sized businesses and the consumers in Texas. It operates, throughout Texas. Here, I'm not going to read all the areas off, but it's primarily in Texas. Their ex-dividend date is again next Thursday on the 13th. They would pay out on the 1st of October. This stock has had quite a bit of growth here. You can see their price here in the orange. They're up nearly 12% on average per year. Their largest number here is the net income, going up 26.8% on average per year. That's pretty normal for a bank. We've been in some prosperous times. Coming out of 2010, that was one of their worst periods. They have came out of those lows, and this company is actually all in the triple digits. So their growth and net income, free cash flow, and revenue is actually in the triple digits instead of the double digits, which we've seen in the past. So looking at their 1-year chart information here, they pay out 36 cents per share each quarter, or $1.44 per share the entire year. They're currently priced at $75.09. They have a dividend yield here at 1.89, which is actually looks like it's pretty, below where it normally was here in the past. You could have bought this at a 2.25 back in September 2017. PE right now is sitting at a 17.92. Forward PE is at a 16.31. You're getting it with a price to sales at a 7.0 and a price to book as a 1.33. Their price to book does look actually pretty healthy, but all their other numbers here, their prices ran up from $60 points within there, now up to $65 point, and their yield has dropped not quite as as low as in the past. Here, if you bought it in February, their price had actually shot up, where many other stocks had actually fallen during that February-March period. This stock was actually at its highest peak back in February and March before falling back down. So when charted does show the current stock does have a higher price over yield, which may indicate it may be overvalued at this time. The stock is above the industry average of 16.2 and sitting below the S&P 500 average of 25.10. It has a PE right now of 17.92. The dividend yield on average is right around 1.92, 1.89, depending on the price on that day. Annualized payout, again, $1.44 per share each year, or 36 cents per share each quarter. They have a very low payout ratio of 31.2 and have been growing and paying out dividends for the past 14 years. So ADP, recession-proof, multiple recessions. This one here, it's gone through the past recession, but it looks like, if you go back 14 years, that puts it at 2004. So check out their history to see if they had just started paying out dividends back in 2004 and had just continued to pay out dividends through that downturn. That would be something to look at. The number 4th stock is ticker symbol PKG, the Packaging Corp of America. They produce cardboard and coagulated products in the United States. Their ex-dividend is on Thursday, the 13th of September. They would pay out on the 15th of October. So quite, a couple weeks there in between ex-dividend and payout. This one, triple digits and all of their numbers: dividend increase, price, revenue, free cash flow, net income. Here, if you look at their price, they're up 32%, 32.5% on average every single year, or 325% over the past 10 years. Very healthy. It's the dividend, 16.3% on average per year. It looks like they did maybe have a dividend cut here, or something went on here back in 2008 and 9. It looks like they did cut their dividend. They have had dividend growth for the past 7 years. So it looks like they did cut their dividend back during that downturn, but then increased it on average about 16.3% over, year over year. And they've had solid returns as far as net income, free cash flow, and revenue as far as their tenure go there. So looking at their 1-year information here, let's go ahead and scroll there. So they pay out 79 cents per share each quarter, or $3.16 per share each year. They're currently priced at $109.22. One of the lower points here you can see here for the past year. Their current yield is at a 2.45. So this right now, if you're buying and looking at the stock, you're buying this stock right now at $109, which for the year is at its lowest point. You're also locking in one of the highest yields here at 2.45, a PE at 14.07, forward PE at 13.73, price to book at 4.3, and price to sales at 1.5. So this one just kind of looking at, yield. So when charted, it does show the current stock does have a higher yield over price, which would indicate it may be undervalued at this time. The stock is actually above the industry average of 12.7, sitting at a 14.07. It is sitting below the S&P 500 average of 25.10. It is sitting below 60% payout ratio, dividend growth for the past 7 years. So looking at the numbers wise, dividend yield, at one of its highest points for the past year, you would lock in currently a 2.45. Forward PE is expected to fall. Earnings per share are expected to rise. That's why I kind of added this one in the group. They have their price to book has actually been going down, and their price to sales remains about that same. So that is ticker symbol PKG. And in the fifth stock here is ticker symbol THG. This is a Hanover Insurance Group. They underwrite personal, commercial, property, and casualty insurance coverage in the United States. It operates in 3 segments: personal lines, commercial lines, and other property and casualty. So ex-dividend is on 13 September, which is next Thursday. You'd have to buy the stock on Wednesday or prior. You would then get paid out on the 28th of September. This one, you can see their net income has grown up over 1,000% there, 1.01,000%. Their price is up 235%. While it doesn't look like much here, you can see here, it almost looks like a flat line here on the right, but they had to make room for this ginormous net income that they've grown. So this kind of throws out all these little numbers here. It makes it look much flatter than it is. If we had actually taken this line out, their net income, their free cash flow would be much higher currently than their revenue and their dividend growth. So dividend growth, very small growth, maybe 2% on average per year. So most of them, they're just basically like a dividend growth company where they may not pay out as much. So they're currently sitting at a 1.76. So anything with a yield around 1.5, 1.7, those dividend yields, a lot of those companies are growth companies. They have a lot of growth potential. They reinvest a lot of their earnings back into their company. You can see payout ratio, 25% payout to their shareholders. 75% of their earnings are reinvested back into the company, growing their net income, their revenue, their free cash flow, building up their company. This is more of a growth dividend company, so you would just buy it, expect that growth, depending on their financials and how it kind of plays out in the future, but then you'd also get paid out some dividends along the way. So here, looking at their 1-year chart, they pay out 54 cents per share each quarter, or $2.16 per share each year. They're currently priced at $122 with a yield of 1.72, 1.76. Their current PE ratio is 23.06, which has been coming down, and their forward PE is at a 14.29. Their price to book is at a 1.77. This is, financial insurance company, so price to book, I always like to see it between that 1.3, 1.7 range, and price to sales right now is at a 0.9. So when charted, it does show the current stock does have a higher price to over yield, which would indicate it may be overvalued at this time. The stock is above the industry average of 18.9. It's sitting at a 23.6, so I put in 21.4, so I have to correct that. But look at their forward PE is at a 14.29. Their earnings, while I didn't include in here, we won't check that right now, but their earnings are expected to grow. This one does look like a pretty good growth company here. Price to book at a 1.77, which is below 3.0, where value investors would consider it a value. So stock, while it is currently trading at a 23.06, in the future, the PE is expected to fall to a 14.29. Their earnings are expected to grow very nice right now. And dividend yield, 1.76%. Annualized payout, 2.16. Payout ratio, 25.1. And dividend growth for the past 6 years. So those are all the stocks that have ex-dividends next week. If you guys had to pick one single stock here, which one would you guys pick? Would you guys pick Public Storage, ticker symbol PSA? Would you guys pick ADP, the Automatic Data Processing Company? Would you pick PV, Prosperity Banking? Would you pick PKG, which is Packaging Corp of America? Or would you pick the Hanover Insurance Company? While this one may not be currently valued, I do see potential for this one continuing to rise. I would say that Hanover is a good growth dividend potential, but if you're looking for a value buying opportunity right now, I would say that the value buy in this list is probably the Packaging Corp. But of course, it does require more information. Their revenue, free cash flow, and net income up triple digits. Their price, their dividend growth, all looks very nice. You're currently locking in at a 2.45% yield with a current price tag of $109. This looks very inexpensive when you look at price to book, price to sales in comparison to its history, and you're buying it with 7 years of dividend growth. They may cut it in the future, but at the same time they may not. They have a very low payout ratio at 39.8. So my pick for value would be PKG, and my pick for growth would be THG. So hopefully you guys have enjoyed that little snippet I wrote. Of course, I'm not a financial advisor or tax professional. The information provided is my opinion for entertainment and fun. This is just me as a financial investor trying to help others make the money work for them. And of course, I don't own any one of these stocks, so no big disclaimer there. I used to own ADP, but it's very expensive now and would not buy into it right now. But that is it for this guy's video. If you guys did enjoy the video, hit the thumbs up button below. I highly appreciate it. Leave a comment section below as to what stock you would pick and add, or not add to your portfolio, but which one would you recommend as a value buy and which one would you recommend as a growth dividend stock. Let me know in the comment section below, and thank you guys for tuning in. I will see you next time. Have a great day. Bye.